NIO stock has been through an absolutely brutal stretch. Since November, shares are down more than 30%, and zooming out even further, the stock is nearly 90% below its all-time highs. While that kind of move feels shocking, the reality is that the breakdown was visible on the chart well before it happened. Early in the year, NIO formed a classic head and shoulders pattern, and once the neckline around $6.73 broke in November, the downside target became clear. That move played out almost perfectly, with the stock tagging the 474 area in early December. Since then, price action has shifted from free fall into a sideways consolidation, suggesting the selling pressure has at least paused for now. In the short term, this base actually looks constructive. There's room for a potential bounce, but it comes with a big test overhead. The 539 level is the key zone to watch. If buyers can reclaim that area, it weakens the bearish structure and opens the door for momentum to shift back in their favor. If it fails, the bigger picture still resembles a bear flag, which often leads to another leg lower. On the downside, major support sits near 428, an upward sloping trendline going back to the spring. A move into that zone would likely attract buyers looking for at least a short-term bounce. While the technical picture is at an inflection point, fundamentals are starting to shift sentiment. On December 29th, CEO William Li delivered more confident commentary around the fourth quarter, stating that vehicle sales should exceed 30 billion yuan. That statement mattered because earlier Q4 guidance had disappointed the market and sent the stock sharply lower. This new confidence suggests execution is stronger than investors initially feared. Delivery numbers back that up. November marked a major acceleration, with over 36,000 vehicles delivered, representing more than 76% growth year over year. October was even stronger, and the third quarter overall saw deliveries jump more than 40% compared to last year. That kind of momentum shows improving efficiency and sustained demand, even in an increasingly competitive EV market. A big driver of that demand has been the launch of the third-generation ES8. Within just 11 days of release, the vehicle reached 40,000 deliveries, an impressive milestone for a premium three-row electric SUV. It reinforces NIO's brand strength in the higher-end segment and plays a meaningful role in supporting elevated delivery targets for the quarter. But despite all of this growth, the core issue hasn't gone away. NIO is still losing money. Revenue has surged over the past few years, yet losses have grown even faster. The more vehicles the company sells, the more pressure it puts on margins. Management has stated that the fourth quarter could mark NIO's first profitable quarter, which would be a major milestone, but the market remains skeptical about whether that profitability can be sustained. That skepticism is understandable. Competition in China's EV market is intense, with aggressive pricing wars forcing manufacturers to sacrifice margins just to hold market share. NIO isn't just competing with BYD and Tesla, but also with a growing list of well-funded domestic players. Even as profitability is achieved briefly, maintaining it long-term will be far more difficult. Adding to the challenge, government support is fading. China is cutting EV tax incentives starting next year, and those benefits are scheduled to disappear entirely after 2027. We've already seen how sensitive EV demand can be when incentives are removed, and NIO could face similar pressure as consumers lose purchasing support. The company is trying to adapt by offering lower-priced vehicles and expanding its battery swap program to reduce upfront costs. But there's no guarantee those efforts will fully offset a broader slowdown. International expansion was once seen as a major growth lever, but that path has become more complicated. NIO has expanded into several European markets, yet new tariffs on Chinese electric vehicles ranging from 17 to 35% have severely damaged the economics. For a brand built around value, adding that kind of cost undermines the entire strategy, forcing the company to choose between shrinking margins or pulling back expansion plans. Today, NIO trades at a deeply discounted valuation, just over 1x trailing sales. The market is clearly pricing in significant doubt about the company's future. If NIO truly delivers a profitable quarter and proves it can maintain that performance into 2026, the upside from these levels could be meaningful. But if profitability slips again, investors may continue to view any rally as temporary. At this point, NIO is no longer a simple growth story. It's a high-risk turnaround situation, sitting at a technical and fundamental crossroads. The next few quarters will likely determine whether this is a long-term bottom forming or just another pause before the next major move.